All right, today we are diving headfirst into the absolutely massive world of the foreign exchange market. You probably know it as Forex. We're going to break down how it all works, how people actually trade on it, and what in the world makes those currency values jump around every single second. So let's get right to it. So just to set the stage here, to really get a handle on the sheer scale we're talking about, let's just start with a number. Every single day, trillions, with a T, trillions of dollars are exchanged on the Forex market. It's just a truly staggering amount of money. And yeah, that mind-boggling volume makes it, well, hands down, the biggest financial market on the entire planet. And that huge scale is exactly what draws in traders of all sizes. Why? Because it's what we call incredibly liquid. That just means it's super easy to buy and sell, 24/7 without any major snags. Okay, so we've established it's massive, but what is it really? Let's zoom in a bit and look at the actual mechanics. Find out what makes this whole global marketplace tick. So, at its heart, the Forex market is simply the place where currencies from all over the globe get bought and sold. And what's really cool is that it's a true 24-hour market. It literally follows the sun around the globe. The week kicks off on a Sunday night when Asia opens up for business, and that ball keeps rolling all the way until New York closes up shop on Friday evening. Then, poof, it resets and does it all over again the next week. All right, now this next part is super important. It's a fundamental concept in Forex that you just have to get your head around. No currency ever moves on its own. They're always valued and traded in pairs. And a currency pair, well, it does pretty much what it says on the tin, right? It shows you the value of one currency against another. I love thinking of it like a constant economic tug of war. It's always answering that one question: which one is stronger right here, right now? Okay, so let's take a really common pair, GBP/USD. The first currency you see, in this case, the British pound, that's what we call the base currency. The price you see quoted is always telling you how many of the second currency, the quote currency, so US dollars, it's going to take to buy one single British pound. And check this out. Here's a perfect example of how that value can change over time. If you look back to the start of 2017, one British pound would have gotten you about $1.22. But if you fast forward to September of that same year, that same pound could now buy you $1.32. So what happened? Simple. The pound got stronger against the US dollar. All right, so we get that values shift, but how does that actually turn into a trade? I know this can seem a little tricky at first, but honestly, there's one simple rule that, once you get it, makes everything just click into place. Because this is the key question, right? When you're looking at pound dollar and you decide to trade it, what are you really betting on? The pound to go up? The dollar? It's a super common point of confusion, but we're about to clear it up. And here it is. Here's that simple rule. You are always, and I mean always, trading the first currency in the pair. That's the base currency. So if you hit buy, you're betting that this first currency is going to get stronger. If you hit sell, you're betting it's going to get weaker. That's it. It's honestly that straightforward. So let's put that rule right into practice. If you buy the GBP/USD pair, what are you doing? You're betting the pound is going to rise against the dollar. And if you sell it, you're speculating that the pound's value is going to drop relative to the dollar. See? Your entire trade, your whole focus is on what happens to that first currency. Okay, now we've got to talk about something that's incredibly powerful, but also you've got to be careful because it's very risky. It's a tool that's absolutely central to Forex trading, and it's called leverage. So what is leverage? Well, think of it as a tool that lets you control a really big financial position with a pretty small amount of your own money. Let's make that real. With something like 100-to-1 leverage, you could control a $100,000 currency position with just $1,000 from your own account. You're controlling a much larger amount of money. And the appeal of doing that is, well, it's pretty obvious, right? It hugely magnifies your trading power. It gives you the chance to make some pretty significant profits from even these tiny little movements in a currency's value, all because you're controlling a position that's so much larger than what you put in. But, and I really can't stress this enough, leverage is a classic double-edged sword. Just as powerfully as it multiplies your potential profits, it does the exact same thing to your potential losses, and it can happen just as fast. This is why understanding risk management isn't just a nice to have in Forex, it is absolutely critical for survival. Okay, so we've covered what the market is, how the trades work. The last piece of this puzzle is what actually makes these currency pairs move up and down all day? What are the big forces driving all those fluctuations we see every single second? The short answer is pretty much everything. But the biggest market movers, the things you really have to watch out for, are usually major economic data releases. We're talking about things like central bank interest rate decisions or big unemployment numbers coming out. A surprise interest rate hike, for example, can send a currency rocketing up in minutes. And of course, you've got major political events, things like elections or big referendums. Those can cause massive, immediate shocks to a currency's value. So, what's the big takeaway here? Look, the Forex market is the largest and most accessible market in the world, no doubt about it. But its unique mechanics, from the way currency pairs work, to the high leverage, to the fact that it never sleeps, all of that demands some serious respect and a real understanding. And that leads us to a final, pretty critical question to think about. In a market that is literally always on, how do you protect yourself from the risks that are always awake, somewhere in the world?